the CARES Act on unemployment. I'd like to introduce our three presenters and provide a little background first. Eric Namey, his primary areas of practice include the employment benefits, taxation, and tax litigation. He has been with the firm since its founding in 1987 and heads its taxation, employment benefits, and employment law practice group. He has practiced in employment benefit matters for more than 33 years and represented clients before the IRS for more than 35 years. He went to law school at the University of Kansas and also graduated Wichita State University with an accounting degree. Brad Schlossman joined Hinkle Law Firm in 2007, where his practice is concentrated primarily on employee benefits and ERISA law, as well as government investigations. He graduated law school at George Washington and went to undergrad at the University of Pennsylvania and graduated magna cum laude with special distinction. Jim Spencer has the practice areas of education law, employee benefits and ERISA, employment law and litigation, and executive compensation. Jim went to law school at the University of Kansas and was on the law review there and received the Order of the Coif. He went to K-State as an undergrad and has a business administration degree. And I'm going to hand this over to Brad first. Brad, it's all yours.
Great. Thank you very much, Scott. This is my first presentation doing on these webinars, so hopefully this all goes smoothly. You'll have to bear with me if any mistakes get made. I do want to thank the many hundreds of listeners who are out there all across the country on this issue. I appreciate particularly those on the West Coast who got up so early to join us, and that really means a lot to us. And also, I would encourage you to stay tuned. If you've got questions, please feel free to submit those through the chat box. To the extent that we can, we will answer those, either throughout or more likely at the end, and we'll sort of see how that goes. We're also, I was joking earlier that we're going to be raffling off 2 rolls of toilet paper and 6 sheets of dual-ply paper towels, so make sure you listen through the very end. Okay, I'm going to talk about today, and we're going to start off on the retirement plan provisions in the CARES Act. Now, there's a whole wealth of issues, but we're going to focus primarily on the coronavirus-related distributions, the plan loans, and the required minimum distributions. So the first issue is that these new, what I'm going to call CRDs, coronavirus-related distributions, are only available to qualified individuals. And we're going to define what that means on the next slide. But we obviously have a lot of individuals who are suffering right now. Their income has declined dramatically. And so one of the things that Congress did was to make available the opportunity to tap into their retirement plans to the extent they can. And actually I'm getting a little help now with my thank you very much. So I appreciate it. Little technical issue. All right, great. So the Congress under the CARES Act made available the opportunity to tap into that amount. And this is a sort of like a hardship distribution, but it's going to be much more liberal. So these corona-related distributions, you can now get up to $100,000. I mean, obviously, it's 100% of your vested account balance or $100,000. So whichever is less. But that is significantly greater than there has been available under, say, the traditional hardship distributions. These would have to be distributed before December 30th, 2020. and they would be available from pretty much any qualified plan. So your 401k plan, profit sharing plan, 403b plan, governmental 457b plan. So if you have a private sector, if you're a nonprofit and you want to tap into your plan, this is not going to allow, the CARES Act will not allow you to get a coronavirus related distribution from a private sector, a nonprofit 457 plan, a 457b plan. And it also will, you can get it from the IRAs. So who is a qualified individual? Well, the statute defines qualified individuals, and you can see here up on the screen. So the first part is if the employee himself or herself has been diagnosed with COVID-19, and that is from, a CDC recognized test. So it can't be something that you went down and purchased at Walmart that's sort of on a black market. I don't know how much of that's going on, but just in case. If your spouse or dependent was diagnosed, the broader one is this third one. If you've experienced any adverse financial consequences as a result of being quarantined, furloughed, or laid off, if your hours have been reduced, if you're unable to work due to lack of childcare, or if you yourself have a business and you've had to close or reduce the hours. Now, we're still awaiting regulations on this. So a lot of those, some of these requirements may well be fleshed out by regulations that the IRS will issue, presumably here in the next few weeks. But right now, what we have to go on is simply the statutory text. So when you look at that, I mean, it's a pretty lax requirements. I mean, what does it mean to have suffered adverse financial consequences? I mean, it seems like a very liberal standard. And, unlike with the traditional hardship distributions, where the employer is obligated to verify that the employee has an immediate financial need, with these corona-related distributions, as long as the employee is representing that he or she has had that adverse financial consequence, one of those described in here, then that's sort of good enough for purposes of the statute. So Congress really wanted to make sure that individuals had that access to their plan accounts and were not going to be burdened by the significant regulatory requirements and proof thresholds that exist normally with their retirement plans.
And this is Eric Namey. I'm here to just chime in from the peanut gallery periodically. I might add a couple of points on that. We are, like Brad said, we're waiting for guidance and regulations and or in some kind of direction from the IRS, and it will be coming and hopefully soon. One of the questions we get a lot regularly is this adverse financial condition consequence. What if the employee still has their job, they haven't had a reduction, they still continue to get paid, however their spouse is not working? Is that an adverse financial consequence that would allow a coronavirus-related distribution and the special tax treatment? And the answer is unknown, although we sort of expect the government to expand it in their guidance to cover an adverse financial consequence that might include the spouse's situation, but we're waiting to see.
Yes, thank you. That was very, very helpful. Thank you, Eric. The corona distributions are not going to be subject to the 10% premature distribution penalty. Remember that normally with a retirement plan, qualified defined contribution retirement plan, if you get a distribution before you turn age 59 and a half, that's subject to the 10% early distribution penalty, which is one of the reasons why we always, frankly, strongly discourage plans from, discourage a lot of employers from offering hardship distributions. But here in this context, they are not going to be subject to that 10% distribution penalty. Another really great feature, depending on your perspective, is that the taxable portion of that corona distribution can be spread out over 3 years. Now, obviously, if it's like a Roth contribution, those aren't taxable anyway, because they were taxed at the time they went into the plan. But with these, all of the pre-tax amounts are that you're going to be able to spread that tax out over 3 years instead of being hit with it all at once. And another nice part of it is that the distributions are not going to be subject to the mandatory 20% withholding on the pre-tax amounts. So, normally that participant thinks that he got $10,000, but he only got $8,000 because Uncle Sam took out his portion up front because he wanted to make sure that it was going to be sent to him directly. And this time there is not that mandatory withholding. There is a voluntary withholding. So if you have the participant has the ability to waive the withholding, but it is going to be and there's going to be a special form that you have to give the individual in order to allow him to make that decision. But it is waivable, so we don't have to have that if the participant does not want to make the withholding. And by the way, you can tell from all these changes here that I've got IT people coming in and out of my office. So we're all in this together. I said a Shehechianu before I even started, but we're still going strong. All right, repayments and rollovers. The participants are going to be able to repay that Corona distribution back to the plan or to an IRA if they choose to do so. Now, to the IRA, that's easy. They can just do it, and of course, that's between them and their IRA and their maker. In terms of the plan, some of that is going to turn on whether the plan itself accepts rollovers. And, we're still waiting on guidance on that, and I'm going to let Eric chime in on that in a second, but it is exactly what the scope of it is. I mean, can the participant pay back all of the amounts? Does it just apply to the pre-tax amounts? I mean, if a participant took money, for example, that part of it was Roth, and he needed the money right away, but then he wants that money to continue to be able to grow tax-free, and maybe say 40 years old, but he doesn't plan on retiring until 65. Can he repay the Roth money back to the plan as well? It's not entirely clear. So we're going to await guidance on that. What is clear is that you do have whatever amount you can repay, you're going to have 3 years to do so. And if you do it within that 3-year period, then it is, at least the pre-tax amounts are not going to be subject to immediate taxation. I mean, obviously, when they're ultimately redistributed, then they are going to be taxed. But you can't avoid tax, just like you can't avoid death. But it will, at least on a temporary basis, you're going to be able to avoid any tax. Eric, do you want to say anything more?
Yeah, a couple of things. First of all, these last 2 slides, when we talk about the treatment to the participant, whether they take money out of an IRA, whether they take money out of a regular retirement plan, they get this treatment, and it doesn't have to be anything special, any money that they get. So if a plan is being terminated and it's just a distribution, they'll get the $100,000 special treatment of it as this provision provides, this special distribution rule provides. If they, and all the ability to repay somewhere later. If they take a regular in-service distribution that your plan already allows, maybe if it's a 401k plan, you can't let people take an in-service distributions prior to age 59 and a half. However, for on profit sharing contributions, you can have a lower age, but anybody that takes them out up to 100,000 will get this special treatment. You do not have to add the coronavirus related distribution to your plan. It is a new special limited distribution event that only lasts till the end of this year. You can add it to your plan or not, but even if you don't, if there's other ways the employees get money out of the plan, they get to take advantage of this provision. And then the ability to, over 3 years, not have to pay the tax up front. And again, that's individualized to the participant. If you're a plan sponsor, you're not worried about that the tax treatment of spreading it out. How, like Brad said, how they ultimately repay it is yet to be seen. And it's going to be kind of a nightmare, as you can imagine, if an employee for 3 years, they're paying a third of the tax, and maybe in the third year, they pay the whole amount back to an IRA or to your plan, if you allow it, then at that point, they're going to have to go get a refund, I guess, for the prior year's taxes. So you can imagine what this is going to do to the personal 1040s of individuals. But you as plan sponsors get the choice to add this provision or not. Many plan administrators, record keepers, are coming to you now probably and saying, do you want to opt in and have this provision or opt out? They're giving an opt in or an opt out, and they're having a default. And you'll get a chance to make the choice right now. We'll talk in a few minutes that the formal amendment to adopt this, if you choose to do it, doesn't have to be done for a while. So you just handle it administratively for the moment. And so those are a few comments that I hope are helpful and answer some questions that you may have in your mind.
Great, thank you. And I'm glad you characterized yourself as the peanut gallery, because I always wanted to use the line that I hope everyone likes nuts because I'm standing next to one. Okay, all right. So let's, another nice aspect of this is, of the CARES Act, is on required minimum distributions. And they are not required at all in 2020. Now, this does only apply to qualified plans, so your 401k plans, profit sharing, 403b, and governmental 457b. I know we have a lot of clients, and I'm sure there are probably listeners among the many people listening today that have, nonprofit 457b plans, and they are still going to have to make their RMDs in 2020. So it just applies to the plans that I've listed there in that first slash point. The nice thing, though, is it does apply to everyone in those eligible plans. So unlike the coronavirus related distributions, which are just applicable to qualified individuals, the RMD relief applies to everyone. The other nice part about it is that if you had someone potentially who hadn't taken their 2019 RMD, so it had a required beginning date in 2020, and they haven't taken that 2019 RMD yet, that RMD can also be avoided in 2020. So you sort of have, a double whammy relief for those individuals, and that could be nice if you happen to follow into that narrow category.
And I might add, this provision has somewhat limited impact on most of you, because you don't have to issue an RMD, a requirement, if somebody's still employed, unless they're a 5% owner. So for most plans, they haven't had to deal with them heavily. But if you've got owners that are in this category of getting a required minimum distribution, it could apply. And that's who's worried about this primarily. And the other thing that's kind of odd is they're saying you don't have to make it in 2020, but what if the owner wanted to? A normal required minimum distribution is you're not able to roll it over to an IRA. If you voluntarily take it 2020, can you roll it to an IRA? I don't know. We're waiting for guidance.
Okay. Another feature of the CARES Act that they have made some nice modifications to deal with plan loans. Now, the normal rule was that, among other things, the maximum amount of the loan was going to be 50%, the lesser of 50% of your invested account balance, or 50 grand. And then you also had to show a number of other requirements, that you'd taken care of in order to satisfy the rules to get the loan. The CARES Act is now going to provide for a temporary increase to that loan limit. So now you can get the lesser of your vested account balance, or $100,000. So it's a pretty significant increase, and this is going to apply to loans made between March 27th, 2020 and September 23rd, 2020, which is basically 6 months from the date of the Act's enactment. I would point out here, though, that this still is, if participants really need the money, then that loan option is available. But we still strongly discourage people from taking that money out of their plan unless it really becomes necessary. And, there are the qualified individual, I talked about the definition of that earlier, and it seems to be a very lax definition. Very, very liberal in terms of who has suffered adverse financial consequences as a result of the COVID-19 epidemic. And it's still, though, if the participant needs it, that's great. But if you think that they are, maybe you ought to encourage them to think about other options before they start tapping into their retirement plan, because that's going to leave a huge gap down the road. There are repayment options. So first of all, the any loan repayments that are due during that period from March 27th, the date of the enactment, to December 31st of this year can be delayed for 1 year. So that gives them a little more wiggle room in paying it back to the plan, which of course they have to pay back a loan anyway. So the normal 5-year repayment period is going to disregard the 1 year delay here in 2020. So, if you take out a new loan, for example, effectively you'd have 6 years, it looks like, to pay it. Now, the interest is going to continue to grow. You can't avoid that. But, then again, you're paying the interest back to yourself anyway in the plan. And what the rules say, the statute says that they'll, for the repayments, they'll then re-amortize those over the extended repayment period.
Now, I might add a couple of things here on loans provisions. Number one, if your plan doesn't provide for loans, you don't have to add loans. They're not making you do that. And if you do have loans, whether you want to increase it to 100,000 and 50% right now we understand that as optional and your choice. And so on that part, you can make a decision if you have loans. You can certainly add loans to your plan now if you want to. Most of our clients that don't have them have chosen not to do so at this point. However, it's your option. The provision that extends loans that are existing already, that's on this slide in the first bullet, and extending the repayment period, all of that on this slide, we're pretty sure that's not, that is just in the rules and you do it. But we're waiting for guidance, but our expectation is that if the participant does not want to have the loan extended, they want to just keep paying, they can. We're expecting the guidance to say that, but we haven't seen it yet.
Yeah, those bureaucrats in DC are working hard right now for a change. Now, Eric did allude to this, and that is that do you have to do these things? Do you have to amend your plan for these new coronavirus-related amendments? And it appears right now that that these are optional amendments. Now, again, we're awaiting guidance, but if you, for whatever reason, do not feel that it would be appropriate to amend your plan, maybe you, well, I'm not even going to offer all suggestions. Maybe you just think that that it wouldn't be most beneficial to your employees, or administration would be too difficult. You do not have to make these amendments. It's entirely up to you. I would simply point out, though, that even if you don't adopt the amendments, the participants are going to still get the benefits of the tax relief. So, for example, say your plan has normal hardship distributions already, and you don't amend the plan to allow for these new coronavirus-related amendments, the participants are still going to be able to avoid the tax consequences, say the early 10% tax penalty for if they haven't attained age 59 and a half. That's still going to be available to them. If you do adopt these amendments, you're going to have to amend your plan document. You can't just snap your fingers. You've got a long period, though, to make those amendments. It doesn't have to be made to the written plan document until the last day of the plan year, beginning on or after January 1, 2022. So if you say had a calendar year plan, it would be December 31st, 2022. I mean, I guess theoretically it could be as late as, November 30th, 2023. And governmental plans, and I know we've got some governmental employers out there as well. Welcome to the show. You've got 2 years after that. If you do terminate your plan, then you're going to have to adopt it prior to the plan termination. One other thing to think about here is partial plan terminations. Now, I hope that many of you are not in a position where you've had to lay off massive numbers of your employees, but I'm sure some of you have. So bear in mind that a plan has what they call a partial termination if more than 20% of the total plan participants were laid off in a particular year. And partial terminations can occur, with something like what's going on here, where you've had to lay off individuals, and the IRS has some special rules in terms of, well, what happens, if they're furloughed, are they laid off? I mean, it gets into some technical issues that may even be beyond the scope of today's discussion. We're happy to answer those, afterwards, but it is if you do have a partial termination, say you've had to lay off, a third of your workforce, then the effect of that is that in that plan, all those affected participants become immediately 100% vested. So if you had someone who was, say, 60% vested in his account balance, and you laid them off and the layoff, and it goes back to for the entire year. So, I mean, maybe you had some layoffs in January already because things were slowing down, and now it really got bad in March. I mean, you're going to look at anyone who left employment for any reason at all during the entire plan year, and they then will become 100% vested in their account balance in the plan. So just sort of bear that in mind as you're making employment decisions, that there could be a collateral cost to that.
The partial plan termination issue is real, although there is a lot of activity out there requesting some relaxation of the rules, especially where people may have been laid off and it's in excess of 20%, but then they're rehired within a period of time. And so there's going to be some guidance on this and relaxation of it. So it's one of those ones where don't panic about worrying about 100% vesting yet. Just stay tuned. Just don't forget that the issue's out there, and work with your plan providers and your third-party administrators and all to keep an eye on that ball.
Well, and you can always trust Congress and the IRS to do the right thing and act reasonably as well. So that's another reason not to panic. Okay, so at this point, I want to switch to the welfare benefit plan issue, and want to talk about the impact of, kind of let you catch your breath here, and then we're going to talk about the impact of these reduction in hours and layoffs, furloughs, leaves of absence, whatnot, on your welfare benefit plans. So it's one of the issues that, and I think we've talked with a lot of our clients, and I know we have some of our clients out there too, when you have significant employment decisions that in any context, but particularly now in the wake of the COVID-19 pandemic, that can have a big impact on the employee's ability to maintain coverage in your welfare benefit plans. And when I say welfare benefit plans here, I'm talking about not only your medical plan, but also, your dental plan and your short-term disability, long-term disability, group life insurance, health flexible spending account, the full gamut. So all the welfare benefit plans. I mean, I keep talking to a lot of employers who are focused on the medical plan for good reason, but sometimes they forget that they have a much broader array of welfare benefit plans that they're offering, and employment decisions can impact all of those. So when you look at this, for example, any of these decisions, if you reduce people's hours, you temporarily lay them off, you furlough them, leave of absence, you actually terminate them. And each of these different kind of employment decisions can have different impacts on an employee's eligibility under the plan. And ultimately, you're going to have to look at what the terms of the plan document say. You're going to have to, as we'll talk about here, consult with your insurance carrier, maybe your stop loss carrier. But all of these decisions, all of these employment decisions can well have a impact on those plans. And we got to see what the eligibility conditions currently are. So, in your plan document, hopefully you have robust provisions that detail what individuals' eligibility is in these different types of circumstances. Some of you out there, no doubt, have a wrap document. Congratulations. But I suspect that others of you, and we'll let you remain anonymous for now, probably don't have a wrap document. And maybe all you have is the insurance certificate that you received from your carrier. And it may say that, individuals are eligible if, say, if they're regularly scheduled to work 30 hours a week. Or sometimes it simply says, we are, the plan covers individuals who are eligible under the employer's eligibility conditions. And then maybe there's something in your adoption agreement or your insurance application that spells it out in very, very brief detail, like, yeah, we're going to require 30 hours a week. But you haven't addressed how you're going to handle eligibility during different kinds of leaves of absence. I will say, number one, this is why it's so critical to have a wrap document and to have all these issues spelled out. But let's talk about some examples then where it can come up. So paid leaves of absence. Well, most plans allow an individual to maintain coverage during a paid leave, whether it's PTO, vacation, paid sick leave. As long as they're receiving pay from the employer, then the plan typically lets them maintain the coverage. The plan doesn't have to do so, but almost all plans do. When it comes time for FMLA leave, the FMLA regulations require that an individual be allowed to continue his or her coverage in the plan during that period of FMLA leave. They've got to pay the premiums if you require them to do so. And, some employers just say, hey, we'll go ahead and cover you while you're on FMLA leave. But you can, as an employer, require the individual to pay for the coverage during the FMLA leave. In terms of non-FMLA leave, it really is a matter of the plan document. So, if you have unpaid leave of absence that is not FMLA leave, maybe the participant has exhausted all of his FMLA leave. Maybe she isn't even eligible because she hasn't worked there long enough. Maybe you are an employer that is sufficiently small, or you've got such remote operations that certain individuals aren't even subject to the FMLA leave requirements. So, do you have other provisions in your plan then that would allow an individual to continue coverage when they go out on a leave? If you simply terminate an individual, sorry, our work has dried up, we're going to have to let you go. Sort of easy. That then you're going to have to offer that individual COBRA coverage. A lot of plans, continue the coverage through the end of the month, but beyond that, that participant is going to have to go on COBRA if he or she wants to maintain the coverage under the employer's plan. Unpaid leaves of absence, though, if I've seen one, then I've seen one. As the old saying goes. We have all kinds of different provisions. Some employers say we're going to let you continue through the end of the month. Some employers say we're going to go 6 weeks. Some it's 2 months. Some it's 6 months. It really just runs the gamut in terms of what our clients do. But that has to be in the plan document. And the problem is what happens if, say, you have allowed an individual and your plan doesn't have any provision like that, and you put an individual out on an unpaid leave of absence, and it's April, whatever today is, April 8th, I guess. And so, that individual then is going to be able to probably maintain coverage through the end of the month, but after that, it's over. And so if you've now allowed that individual to continue coverage, and now let's say it's May 2nd, and the problems come about not when you have someone who is just going to the doctor's office for a $150 test. The problems come is when you have that individual who is really sick and then he gets hospitalized. Maybe it's COVID-19, and the or anything. I mean, maybe it's cancer treatment, and all of a sudden the hospital bill comes in and it's $500,000. And you're saying, well, gee, I guess insurance is going to cover it because the premiums have been continued to be paid. But your carrier and or your stop loss carrier is going to say, no, that employee lost coverage. And so you, Mr. Employer, are now on the hook for all of that. So you may find yourself self-funded when you thought you were fully insured, or you may find yourself on the hook for that full amount because your stop loss carrier says, I don't think so. So that can be a very, very unpleasant and expensive lesson. And we strongly encourage you to look at your plan document to see what, if anything, it says on that. And if it doesn't say anything, it's time for you to amend that plan document post haste. Another issue that comes up is, let's say you have a provision that says, look, we give our individuals, a month of unpaid leave when they are to maintain eligibility under the plan. Well, does that unpaid non-FMLA leave overlap with or run consecutive to the unpaid FMLA leave? With unpaid FMLA leave, with any FMLA leave, actually, you get up to 12 weeks, depending on your eligibility. So if you have an individual who, say, uses up those 12 weeks of FMLA leave, do they then get an additional 6 weeks of unpaid leave in which they can, a period of eligibility during those 6 weeks where they can stay in the plan? Most of our clients have everything run simultaneously, so they wouldn't, and it's 12 weeks period. Some clients do it differently. But again, make sure you look at what your plan document says. And if you don't have a wrap document that spells out those conditions, get one, or at least have, an amendment prepared that deals with these issues. And, we're happy to help you with that, or whoever your benefits counsel is can do it too. But it is something that you really need to have written down. How long does eligibility continue? As I mentioned, most of our plans, because this is sort of a very weird time, our plans say that, an eligible employee is someone who, say, is regularly scheduled to work 30 hours a week. And if that individual is no longer regularly scheduled to work 30 hours, then they lose their status as an eligible employee. And presumably they'd lose their coverage at the end of the month, and they'd have to go on COBRA if they wanted to continue. But, then we have employers who will say, look, it's for any paid or unpaid employee, paid leave, including, 6 weeks of unpaid leave. Well, you could have an ironic situation where an individual is normally working 40 hours a week, and for business reasons due to the economic climate now, you reduce their hours to, say, 10 hours a week. And that means that individual is going to lose eligibility under the terms of the plan at the end of the month. But if you had someone who today went out on an unpaid leave of absence, they'd have up to a month of coverage, which would expire, in the middle of May, which would mean that they could continue their coverage in all likelihood through the end of May. So it really is sort of an unusual situation, and you want to make sure that you have addressed that in your plan document. I will say here, no, please go ahead.
A couple of things, Brad.
Yeah, please.
One thing we've encountered with a lot of our clients is they have plan documents with very specific rules, like Brad said. And typically they have an eligibility condition, a regularly scheduled work week equaling exceeding 30 hours, which is kind of consistent with Obamacare. Some have more generous provisions. But when people go on a reduction in hours, they obviously no longer have a regularly scheduled work week of 30 or more. They've got a regularly scheduled work week of something less, and that may last a while. Just to let everybody, a lot of our clients are saying, we don't want to cut people off right away just because they no longer meet our definition of eligible employee. So they want to just temporarily change the definition to allow those people who were already eligible to stay on for a while. And it's commonly right now, we're seeing people want to stretch it out and let people that have a reduction in hours stay on their benefits for 60 days or 90 days. And so that's kind of what's commonly happening out there. And then they'll revisit it, and don't just but you don't ignore the terms and conditions of your benefit plan. You've got to do at least a temporary formal amendment. And that one isn't put off until 2022. You got to do it now. And like Brad, similarly, if your document has people that go off on an unpaid leave that's not FMLA, and it cuts them off too quick right now, if your provisions do, you do need to amend them. And again, you can amend them temporarily, which is what we're doing for our clients, just to get through this period. And it all goes away and you revert back to your old provisions starting next year. So those are just to amplify that, a little simple temporary formal amendment to whatever legal document you have would be in order right now.
That's right. And along that same line, I've got in this slide, if you're fully insured, what does your insurer have to say? Remember that the wrap document that we prepare is wrapping around your underlying insurance policy. And so you need to make sure, though, that the insurance company is going to be on board with the expanded eligibility. Now, for our listeners here in Kansas, we have, I know Blue Cross has been fairly generous, and the other carriers have too. And they've said, look, during this period of the economic downturn, at least I think it's through mid-May is what they've basically said so far, we're going to relax the requirements. Well, that's fine for the insurance certificate. But your plan document, if it says that the eligibility of an individual ends, say on as soon as their hours are reduced, then the fact that the insurance certificate would theoretically allow them to stay in the plan is not going to be enough. You're going to have to amend your plan to allow that. Vice versa, if your plan said 90 days, but the insurance company said, no, after 60 days, we're not going to go along with that. That's as much leeway as we're going to give. Then you need to make sure that you're consulting with the carrier, because you don't want to go and expand eligibility beyond that which the insurance company is willing to do.
And I might add, when we say insurance company, we're not just talking about your health insurance, but all of the different benefits you offer. If you're going to extend and let people stay on your benefits for a longer period of time than traditionally you have, you do want to clear that with your insurance company or have your broker clear it, which we've found they've been very much amenable to, just like Blue Cross here. As long as premiums are being paid, they're going to let people stay on the plans longer than they traditionally have. But you do want to clear it. And similarly, if you're self-funded, make sure your stop loss carrier is good with whatever extended period of time you're letting people who normally wouldn't be eligible stay on for a while. So both of those are good. And if you have a broker, use your broker. They will run the traps for you. We haven't found at this point anybody that's hit a bump in the road when they've asked for permission. But you do want to have the permission, and you would like to get it in writing.
And I would just say too, and with the fully insured carriers have been pretty good. I agree with Eric. The stop loss carriers, I mean, they can be rather heartless, and I sort of say it kind of half facetiously, but I mean, every year I get probably 3 or 4 calls from clients who are facing, stop loss carriers that have said, look, we've got this participant has incurred $500,000 or $1 million in claims. I mean, you've all dealt with that or many of you have dealt with that. I hope some of you don't have to ever deal with it, with extremely high medication costs, biologics, biosimilars, when somebody is hospitalized and and they technically were no longer eligible because their hours had been dramatically reduced. The employer was trying to do right by that employee and saying, look, we're going to keep them covered because we feel bad for them. They're a longtime employee. We'll continue to have the premiums paid, but we're going to let the coverage continue. And then that stop loss carrier comes in on an audit, as they frequently do, and says, hey, what's this $750,000 claim for hospitalization for Bob Smith? And they're like, well, Bob hasn't really actively worked here for several, 3, 4, 5 months. And they'll say, no, we're not going to cover that. So it's just really important that you keep your plan document provisions accurate and make sure that that your stop loss carrier is aligned with what you're doing. Eric talked about this a little bit, in terms of the amendment. I mean, it doesn't need to be anything too elaborate. I mean, we're dealing with this with a lot of our clients, preparing sort of tack-on amendments. That's what kind of my terminology here, where we've basically said for a temporary period, maybe it's up to the employer, maybe it's 60 days, maybe it's 90 days, where that eligibility can be expanded if the person has had their hours reduced and or is on an unpaid leave of absence. Maybe you furloughed them. You haven't actually terminated them. You've just been furloughed. So it's sort of the equivalent of an unpaid leave of absence. And employers can do what some have said, look, we want to expand it to both. If you've had your hours reduced or you're on an unpaid leave, we're going to expand the coverage. Others have said we're only going to do one or the other. That's okay. It's up to you. But that does need to be in writing, and it needs to be in writing before you would implement that policy. In terms of the amendment itself, whether you're going 60 days or 90 days, we also are encouraging our clients to have the amendment expire no later than the end of this year, when all of that relief under the Families First Coronavirus Response Act ends. So that's going to be important as well. So if you find yourself in that position, please contact your employee benefits counsel. If you don't have one, feel free to contact us. That's why we're here. But this is something that you don't want to put off, because the financial consequences can be extremely significant. Okay, that's all that I have at this time. So at this point, I am going to I will stick around. We've got, again, if you've got questions, please feel free to submit them through the chat box, and we're happy to answer those. And at this point, I will introduce it over to, point it over to Jim Spencer, who will be a far less effective substitute for Sominex than I have been. So, because Jim will be much more exciting. So thank you very much. And Jim, on to you.
Thanks very much, Brad. If you will stop sharing your screen, I will be able to share my screen.
Okay.
See if we can get the technical issues worked out here, folks. All right. Let's see here. All right, I think that worked. Brad, does it look good on your end?
Yes, looks terrific.
Okay, folks. So this is the first time I've done a webinar with a PowerPoint, and it's not a very long PowerPoint, but I threw something together to give you guys something to look at as we're talking here. And I do really recommend that if you've got some Q&A or some questions, go ahead and submit those using the Q&A function in the Zoom app, and I'll get to those as we get on here. Somebody just asked, will we get a copy of the slides today? Yes, you will. So it's working. So there are kind of two things that I'm going to be talking about today, and they're related. But we've been getting hit with a lot of information and new laws and this sort of thing from the federal government as a result of the pandemic, which is leaving everybody's heads swimming. Including the attorneys, as we're trying to get a handle on everything that's happening with the changes in the law. But the two things I'm going to be talking about today are the Families First Coronavirus Response Act, specifically the paid leave requirements that are imposed by that law, And then I'm also going to be talking about the some of the effects of the CARES Act on unemployment compensation. I've been getting quite a few questions about both of these laws from my clients, and so I thought it'd be good to talk about these things with you today. So on the Families First Coronavirus Response Act, this law was signed by President Trump on March 18th. And what it does in general is it requires employers to provide two types of new leave to employees. And the two types of paid leave are, the first is what I call expanded FMLA leave, which requires pretty much all employers to provide up to 12 weeks of leave under the FMLA for a very specific purpose. And that is, I'll talk about that here in just a moment. The last 10 weeks of that 12-week period is paid leave at 2/3 the employee's regular rate of pay. The other type of leave is what I call paid sick leave. And it's not just what I call it, that's what the Department of Labor calls it. So I'll just use the terms that they use because it makes it easier if you go and look at their regulations. But paid sick leave, there are 6 reasons that you can take paid sick leave, which I'll cover here in a moment. It's up to 80 hours of leave, okay? So it's basically 2 weeks of leave, paid leave. Part-time employees get less than full-time employees. Full-time employees are employees who work at least, regularly scheduled to work at least 40 a week. So let's talk about the expanded FMLA leave. Now this leave, as I said, requires you to provide 12 weeks of leave, and it is only to care for your child, for the employee's child, if their school or place of care is closed or their child care provider is unavailable due to COVID-19. Okay, and it's really important to remember that the expanded FMLA leave is only for that single purpose. As I mentioned, there are other purposes that can be used for the paid sick leave, those 80 hours, but for the expanded FMLA leave, it's just this single event, and that is if they need to stay home to take care of their kid because their school place of care is closed or their child care provider is unavailable. Now, who is subject to this law? Well, it's not every employer that currently offers FMLA, because this only applies to governmental employers who are already subject to FMLA anyway, and to private companies that have less than 500 employees. So it applies basically to small and medium-sized businesses. If you have 500 or more employees and you're a private company, this law does not apply to you, and you're not required to provide the paid leave. So what is it that we mean when we're talking about an employer with less than 500 employees? Well, the Department of Labor got on the stick and they issued their regulations at the end of last week. I mean, like basically 2 weeks after the law got passed, they whipped out regulations and got them out to us. And basically, when you're counting up the number of employees, you count everybody that you have working for you. It doesn't matter whether they're full-time, part-time, on a leave of absence. You even have to count employees who are jointly employed with another employer. For instance, if you've got temporary employees from a staffing agency, those might be joint employers of yours. And also, there's something called an integrated employer. So like if you've got, you've got one company that's got a lot of, like 300 employees, and then there's a related company, maybe it's owned by the same owner and you've kind of got the same HR people handling things and this sort of thing. You may have an integrated employer, in which case you have to combine the number of employees at company A and company B to see whether you're under the 500 threshold. That same test is used to determine whether you're subject to the paid sick leave requirement, okay? Now, it's really important to figure out whether or not you're subject to the law. Because if you start paying the paid sick leave and you're actually not supposed to be doing it, then you are ineligible for the tax credits that the federal government is going to be providing in order to pay for the paid leave. Because one nice thing about this law is that this is not employer funded. It is funded by the federal government. So if you provide the paid leave required by this law, you do have to pay it out of pocket at first, but the federal government is going to reimburse you for the cost of that, okay? So if you are not actually covered by the law and you provide the paid leave, then you're actually not eligible for the payments from the federal government, and you may end up just funding this all on your own. I say you may end up funding it all on your own because you're probably going to think that you're subject to the law and you're going to get the tax credit, and then later on, if the IRS comes in and looks at this, they may tell you you have to repay it. So that would be a problem if I'm the employer. I wouldn't want to have to pay something and then not get reimbursed or have to send the money back to the federal government. If you're subject to this law, you've got to provide the expanded FMLA leave and the paid sick leave. Now, who do you have to provide it to? Well, for the expanded FMLA leave, you know, if you're already subject to FMLA leave, you're familiar with the eligibility requirements. The employee's normally got to be there for a year. They have to have worked for at least 1,250 hours. They have to work at a work site where there's at least 50 employees within 75 miles. For purposes of this expanded FMLA leave, all that goes out the window. It doesn't matter. Those things still apply for regular FMLA leave. Don't get confused about that. But for expanded FMLA leave, this is available for any employee that's worked for you for at least 30 days as of the date they start, the leave is supposed to start. So it's 30 days. That's not a very long time. So, you know, you still have to provide, the employee has to provide you with notice if they want to take leave to take care of their kid. And they're supposed to provide it as soon as, you know, as practicable. You know, and you can require them to provide you with information. In fact, not only can you require them to provide you with information, you really need to have them provide you with information, because in order to get the tax credits under the law, you have to have certain things in your files to substantiate the reason for the leave. They have to provide you with their name, which you're going to know, the dates that they're requesting the leave for, why they're requesting the leave, and if it's for expanded FMLA, that's obvious. It's for the child care. They have to provide you with an oral or written statement that they are unable to work because of the qualifying reason for the leave. And it's not just, you know, they just want to stay home with the kids, but they've actually got to stay, they actually have to say, I'm unable to work because of this specific reason. And then for this particular type of leave, the stay home with the kids because the school is closed, etc., they have to provide you with the name or names of the child or children who are being cared for, the name of the school, place of care, or child care provider that's closed or become unavailable, and a representation, and they should do this in writing, a representation that no other suitable person will be caring for the child during the period when the employee takes the expanded FMLA leave. So that's not very much information. I mean, it's basically name, rank, and serial number stuff. You know, they don't have to provide you with a notice that the school has closed. All they have to do is provide you with the name of the school. And the regulations from the DOL also say that you're prohibited from asking for additional information or requiring them to provide you with additional information in order to qualify for the leave. So, you know, they clearly made this a very easy bar to jump over for purposes of allowing people to get this leave. So what is a child care provider? I was a little surprised when I read the definition of child care provider in the regulations, because when I read the statute, it talked about how the child care provider had to be somebody that was compensated. You know, they have to get paid for taking care of the kids. And so I was thinking, well, you know, if you're a family member who's just doing it for free because they love the kids, that's not going to qualify. So if grandma can't take care of the kids because she's, you know, self-quarantining or something, that, you know, that's not going to qualify for this expanded FMLA leave. However, what surprised me was in the Department of Labor regulations, they specifically said that the eligible child care provider does not need to be compensated if he's a family member or friend, such as a neighbor, who regularly cares for the employee's child. So if you've got a situation where the employee comes to you and says, look, you know, grandma's always taking care of the kids, and she can't do it anymore because of COVID-19, therefore I have to do it. That's going to be a qualifying reason. Let's move on to the paid sick leave now. Now, currently there are 5 reasons you can take paid sick leave, and this is the 80 hours of paid leave if you're a full-time employee. There's also a 6th, and the 6th is if the Department of Health and Human Services issues some additional reasons for taking the leave, but they haven't done that yet, so I'm not going to talk about it. The first reason that an employee can take paid sick leave is if the employee is subject to a quarantine or isolation order. So the employee is basically supposed to stay home. I was surprised when I read the Department of Labor regulations, but they are including things like stay-at-home orders, which of course we have here in Kansas from the governor. So, you know, if you've got somebody who is staying home because of the quarantine or isolation order, then that would be potentially a qualifying event. One thing I want to make very clear, and the regulations from the Department of Labor are very clear on this issue. In order for anyone to take any of this paid leave, either expanded FMLA leave or paid sick leave, the employer actually has to, number 1, be open for business, and number 2, you know, have work for the employee to do and basically want the employee to be at work. The way I think about this is that, you know, you can't take sick leave unless you're supposed to be at work. You know, so if, like for instance, just in the normal course of things, you know, if a business is closed on Friday, just because the employees don't take sick leave that day, okay? Because they're not supposed to be at work. They're supposed to be home or out enjoying themselves. Pre-pandemic anyway. Now we're just supposed to be home. So, you know, I get a lot of questions about, okay, well, what if we've furloughed people and you know, now there's this stay-at-home order? Do they get paid sick leave? Do they get expanded FMLA leave? The answer is no, because, you know, if your business is closed because you're not an essential employer or an essential business, then that's why they're staying home. It's because you don't have any work for them to do. So they don't get the paid sick leave or the expanded FMLA. They can, of course, apply for employment. The second reason you can take paid sick leave is if the employee has been advised by a healthcare provider to self-quarantine. Now, in order to take this leave, again, they have to provide you with their name, the dates the leave requested, why they want to be gone, that they're unable to work, that sort of thing. But they also have to provide you with the name of the governmental entity that issued the order. That's it, okay? The name of the governmental entity. So, like for instance, if it's here in Kansas and they you know, can't come to work for some reason because of a quarantine order from the state of Kansas, they'd say it's the state of Kansas. That's all it is. They don't have to provide you with a copy of it or anything like that. Now, on the second reason for the paid sick leave, this is being advised by a healthcare provider to self-quarantine. They have to provide you with the name of the healthcare provider, in addition to the kind of the normal stuff that I already said. So, you know, the name of the healthcare provider, you cannot require them to provide you with a note from the doctor or anything like that. Just the name of the healthcare provider is it. So again, it's a very low bar. The third reason that the employee can take paid sick leave is if the employee is having symptoms of COVID-19 and is seeking diagnosis. And in that situation, aside from the normal information they have to provide to you, there's no additional documentation that they have to provide. They don't have to tell you which doctor they're going to, which hospital ER they visited, or anything like that. But they can only take this particular type of leave for the time period when they're taking affirmative steps to obtain the medical diagnosis, like making an appointment, waiting for an appointment, attending an appointment for a test for COVID-19. It's a pretty limited use. The fourth reason somebody can take paid sick leave is that they're caring for someone who is subject to a quarantine or isolation order or has been advised to self-quarantine by a healthcare provider. Okay, so if they've got a family member or a close friend or somebody like this, this is not for the stranger on the street. This is not a good Samaritan rule, okay? Where you see somebody lying by the side of the road with COVID-19 and you decide to take care of them. That doesn't qualify for this. But it has to be somebody that objective observer would look at and go, yeah, I can understand why that person is taking care of this other person. They've got a relationship. And then the fifth reason that an employee can take paid sick leave is for child care purposes. It's identical to the expanded FMLA leave. Okay, so because these two things because expanded FMLA leave and the fifth reason under paid sick leave are identical, that leaves open the possibility that the two types of leave might intersect. They might run concurrent. And as I read the regulations, it's up to the employee whether that does in fact occur, all right? So for instance, if somebody needs to stay home as taking expanded FMLA leave, the 12 weeks of expanded FMLA leave to take care of a child, the employee has the option to use the 80 hours of paid sick leave during the first 2 weeks of expanded FMLA leave. Because remember, the first 2 weeks of expanded FMLA leave is unpaid, but the employee has the option to go ahead and use the 80 hours of paid sick leave during that first 2 weeks. Or if the employee has some employer-provided paid leave, they could use it during that time also, okay? If the employee does not use the 80 hours in the first 2 weeks of expanded FMLA leave, this means that they might use up their entire 12 weeks of expanded FMLA leave, and they've still got the 80 hours, and then maybe they get advised by a healthcare provider to self-quarantine, and they can take that leave at full pay, 100%. I should mention, by the way, I talked about 100% and 2/3 pay. Those are subject to some caps, some statutory caps. So if the employee is eligible for full pay, which would be for reasons 1, 2, or 3 under paid sick leave, they are subject to a daily cap of $511, and then an aggregate cap of $5,110. If they are taking the 2/3 pay under expanded FMLA leave or for reasons 4 and 5 under the paid sick leave, those are paid at 2/3, and they are subject to a cap of $200 per day, okay? And that would be for the expanded FMLA leave a total of $10,000, and then I believe $2,000 additional under the paid sick leave. So it's important to keep those caps in mind, because if you've got highly compensated employees who are taking time off, they are, you're not going to have to actually pay their full pay, and the federal government's not going to reimburse you. Now, what happens if you decide, hey, we've got employees who are being limited by the cap, we want to go ahead and pay them additional money? You can do that. But the government has been very clear that they're not going to foot the bill for that. So if you want to be nice, go right ahead. You can do that, but the government is not going to reimburse you for the cost of that. Okay, somebody has asked me about, on this slide, number 3, is this intermittent? So the question is, symptoms of COVID-19 seeking diagnosis, can you take that intermittently? Interesting question. The regulations talk quite a bit about intermittent leave. I'll just go ahead, and I was going to talk about intermittent leave here a little bit later, but I'll go ahead and do it right now. If the reason for the paid sick leave is anything other than childcare, the regulations say that you cannot take leave intermittently if you're actually going to still be working in the workplace. If you are going to be teleworking from home or another non-office, non-regular office location, then you can take the paid sick leave intermittently, okay? So if you're taking the child care leave for paid sick leave, or you're taking, expanded FMLA leave, you can take that intermittently. I say can. Intermittent leave is it's at the option of the employer. So if the employer doesn't want to allow it, the employer doesn't have to allow it. And they can require the employee to take the leave in a single block. The entire, like for the symptoms of COVID-19 seeking diagnosis, doesn't mean they have to use the entire 80 hours all at once, because it may only take them 10 hours to seek their diagnosis. Then they'd still have the 30 hours left that they could use for another reason, assuming that they're not then advised by a healthcare provider to self-quarantine. If they've got COVID-19, I'm sure that would be the case, or they'd end up in the hospital. So that's how intermittent FMLA leave works. Thanks for that question. I've got some other questions here. And just feel free to keep shooting these things over to me. Are employers required to pay employees in the event of business closures, furloughs, reduced work hours as a result of the state or local government quarantine isolation orders? We talked about that a little bit earlier. If the reason that the employee is not coming into work is because the business is closed, or the business has made a decision to furlough the employees or reduce their work hours, they cannot take the paid leave for that, in those situations, okay? Can employees apply for unemployment in these situations if they are not receiving other forms of paid leave when not working? Yes, employees can definitely apply for unemployment, and I would encourage them to do that. Do any provisions of the CARES Act change the Families First Coronavirus Response Act? The answer to that is no. I mean, the Families First Act was passed first, and then the CARES Act was passed, but it doesn't do anything to change the paid leave requirements under the first law. What about a situation where an employee missed work due to a valid Families First reason before April 1st? And keep in mind, April 1st was the date that this law became effective. What if they missed work for, say, because they were advised to self-quarantine prior to April 1st, but it's paid for after April 1st because the pay period it occurred in, the payroll isn't due until April 10th or something like that. Are the wages eligible for was that paid leave under this law? Can we get the tax credit for that? The answer is no. The law went into effect April 1st, and it applies only to paid leave that is provided on or after April 1st and falls into the requirements that we just talked about. Okay, if an employer is small enough and doesn't fall under the typical FMLA, are they only required to pay the 80 hours of paid leave? That's a great question, and the answer is it depends. And the reason it depends is because Congress allowed the Department of Labor to come up with some rules for determining whether a small business, i.e. an employer with fewer than 50 employees, 50 employees, has to provide the child care leave, either through paid sick leave or through expanded FMLA leave. And when the Department of Labor issued its regulations, it did indeed provide some guidelines for that, okay? And what has to happen is that you have to have an authorized officer of the business determine one of three things. And if that authorized officer determines one of these three things, then the employer needs to document it, and they don't need to allow the employees to take the paid leave for child care purposes. The first is that the leave requested by the employee or employees would result in the business's expenses and financial obligations exceeding available business revenues and cause the business to cease operating in a minimal capacity. In other words, in layman's terms, if this would cause the business to tank, then that would be a reason not to provide the child care leave. The second reason would be that the absence of the employee requesting child care leave would entail a substantial risk to the financial health or operational capabilities of the business because of the specialized skills, knowledge of the business, or responsibilities. So if you've got somebody that's pretty important for your business, you don't have to provide them with the child care leave. And the third reason is if there would not be sufficient workers who are able, willing, and qualified and available to perform the work that the employer needs to have done, then that would be another reason to be exempt from the law. So if you are less than 50 employees and you fall into one of those three things, get it documented. The IRS, the Department of Labor, do not want you to send the documentation to them, okay? They've got enough on their plate. The last thing they need is a bunch of small businesses sending them a bunch of paperwork. But you do need to have that in your records in case the government ever does come calling and want to know why it is that you didn't provide the child care leave to some of your employees, okay? So that's a very important exemption. But otherwise, it doesn't matter how small you are, you have to provide the paid sick leave. You definitely have to provide paid sick leave for the other four reasons, okay? Even if you are exempt from the fifth reason for child care. All right, next question. For an employee that normally works 40 hours per week, is it possible for the employee to work part-time, for example, 20 per week, and the employer still be eligible for the credit for the other 20 hours that the employee can't work? So that's an example of the intermittent leave. If the employer is willing to allow it, then intermittent leave can be used. Now, if the person who's working 40 hours per week if childcare is the reason that they're taking the leave, then they can keep working at your place of business. That, of course, assumes that you're essential and they're essential and all that, and they're not supposed to be home. But or if you've got somebody who's teleworking right now, they could telework for 20 hours per week, and assuming that you actually do have work for the other 20 hours, then they can take the other 20 as paid leave. Could both parents that work for two separate employers both take off work because their kids are out of school, and would then both of their employers qualify for the credit? I haven't seen anything in the guidance from the Department of Labor or the IRS to suggest that that's not the case. So it looks to me like if you've got mom working for company A and dad working for company B, and the kids are out of school because of COVID-19, they would both be entitled to take the child care leave under this law. One thing I did notice in the regulations is that for purposes of the paid sick leave, if somebody was, say, working for employer A and used up 60 hours of paid sick leave and then took a job with company B, they'd only have 10 hours of paid sick leave available at company B. So the government is saying, look, if you're the employee, you get a total of 80 hours. It doesn't matter who you work for, but we're not going to let you have 80 over here and then another 80 over here. I think they're concerned about employees job jumping. But for purposes of the expanded FMLA leave, look, if you're an employer A and you use up your 12 weeks of expanded FMLA leave and then jump over to employer B, well, after 30 days of work, you're going to be eligible to take an additional 12 weeks of expanded FMLA leave at your new employer. Kind of an interesting thing. Are the wages paid under this new law subject to normal tax and benefit withholdings like Social Security, Medicare, federal tax, state tax? Yeah, I mean, you still got to take care of the normal tax withholdings. Sorry, I'm looking, got another question here. Okay, does this still apply to businesses that are exempted in the stay-at-home orders, like from the state of Kansas? Again, if the business is shut down because of the stay-at-home order, which a lot of businesses are right now, the employees employees of those businesses are not eligible for the paid leave. You know, unless they're able to work from home and can take some paid leave that way. I think we've got some healthcare providers on here. So I want to talk a little bit about an exclusion that is in the regulations for healthcare providers. What the exclusion says is that if you are the employer of a quote-unquote healthcare provider, then the employer can decide not to allow you to take paid leave under the new law, okay? And, you know, it's the employer's choice. And what the reason they've got this rule in there, I think, is to make sure that employers who are providing healthcare services are not left without any employees. So, you know, if you're an employee at a doctor's office, if you are an employer that runs a doctor's office, hospital, that sort of thing, then you can actually make a decision to exclude your employees from being able to take leave under this new law. They might not like you for it. The employees might not like you for it, but that's your choice, and there are, of course, good reasons for needing to do that. So I'm looking through a few things here on my desk to see some other important things I wanted to talk about on this new law. Okay, so the law went into effect April 1st, and here we are, April 8th. Some of you may be sitting there, hopefully everybody heard about the law before you got on this webinar, but some of you may be sitting there going, oh gosh, I haven't been doing this thing the right way, or I just wasn't sure what to do, and so I wasn't doing anything. The good news is that prior to April 18th, the Department of Labor is not going to bring enforcement actions against you if you've made reasonable good faith efforts to comply with the act, okay? You know, and if they contact you, you have to remedy any violation that you had, and then you have to promise that you'll do things correctly on a go-forward basis. So I think that's really important to keep in mind, because, you know, this is a brand new law and mistakes will be made. So got to make sure that you're doing things the right way. But if you've been remiss in some of your obligations up to this point, you're going to be okay, I think. One thing that you have to do if you're the employer is make sure that the employment poster for the new law is posted. And if you've got employees who are not working in the office, which is probably most of you, what you need to do is email it to all those people, or you could put it on your company intranet or something like that, just someplace where they are going to have access to it and be able to read about it. I'm going to move on now and talk a little bit about unemployment. And I would encourage you that if you have additional questions about the paid leave law, go ahead and submit those questions using the Q&A, and I'll get to those. So the CARES Act, which was signed into law, I think, last week, does a number of things to help out with unemployment. And I think it's important for employers to have an understanding of how this works, because what I'm seeing in my practice is that as I talk with employers that are, particularly those who are thinking about reducing hours or doing a furlough or something of that sort, because they don't have enough business or they're kind of being forced to shut down by the government, they're trying to figure out what they can do to help their employees. And I've had a number of them, you know, they ask me, well, okay, what about, you know, can we just go ahead and provide them with the paid leave even though we're closing up shop for the time being? And when I tell them the answer is no, that they're kind of disappointed because they were hoping that the government would fund that. But that's where the unemployment kicks in. And, you know, there's some, I think that understanding a little bit of how this works and the type of assistance that's available can give you a little bit more comfort that your people are going to be taken care of. You know, this is a very unusual and troubling scenario that we're in here for the past couple of weeks, and it looks like I don't know how long, you know, at least another weeks, months, who knows. But you know, there is a safety net out there for your employees, and you don't need to feel like you're stuck between a rock and a hard place. I mean, I talked with an employer earlier today, small employer. You know, they don't have much money in the bank sitting there right now, and they're trying to figure out, you know, what do we do with our 6 employees? And really the best option for them was to furlough them and allow them to take unemployment, because they're going to run out of money and they're not going to be able to pay their people, which isn't going to be good for the company and ultimately won't be good for the employees. So one of the things that Congress did was they're providing something called pandemic unemployment assistance. And this is up to 39 weeks of additional unemployment. It's running from January 27th to December 31st of this year. So they made it retroactive to January 27th. I'm not quite sure how that works, but presumably the Department of Labor is coming up with some rules on that, and it'll be clear on how it works. But this is going to cover people that typically have not been able to get unemployment, like self-employed people or employees who are you know, people who are seeking part-time work, people who don't qualify for any other unemployment benefits, or who have exhausted all of their unemployment. So 39 weeks. In order to get this, you have to be able to work and available to work, and you have to be unemployed for a qualifying reason. And there are a number of these, I don't know, 7 or 8 here. I mean, first of all, if you've been diagnosed with COVID-19 or you have symptoms and are seeking medical diagnosis, that's a reason that you can be eligible for this 39 weeks of unemployment. Or if you've got a member of the household who has COVID-19, that's another reason. If you've got child care issues because the school or place of care is closed because of COVID-19, and in order for you to work, you needed the kids to be at the school or place of care, then that's another reason for you to be eligible for this 39 weeks. Another reason is if you can't reach your place of employment because of quarantine due to COVID-19, or because your healthcare providers advise you to self-quarantine. So if the doc has told you to stay home, or you know, or you can't get to your employment because of the quarantine for some reason, maybe some travel restrictions, I don't know, that would qualify the employee to get unemployment this 39 weeks. It even reaches out to somebody who was scheduled to commence a job but can't get there due to COVID-19. So they had a job lined up, they just can't get there. They never were actually employed, but they're going to be able to get the unemployment. Or the situation where the head of the household died from COVID-19 and the employee is now unemployed because he's now the breadwinner or the head of household. That would be another reason to get to 39 weeks. The individual had to quit as a direct result of COVID-19. That's what the statute says. I'm not quite sure what that means as a direct result of COVID-19, but that's in there. or if your place of employment closed due to COVID-19. So, you know, if you're not an essential business and you close, then your employees can get this 39 weeks, you know, if they're able to work and available to work. The second thing that the government did through the CARES Act for unemployment was to provide, and you've all heard about this, an additional $600 per week. And this is available for employees who are collecting regular unemployment, PEUC, which is on the next couple slides, and the 39 weeks of unemployment, as well as other types of unemployment that are out there. This is something that the federal government funds. If the state wants to partake in that, they have to enter into an agreement with the U.S. Department of Labor. I was on the Kansas Department of Labor website this morning, and they got a notice on there saying that they have started the process, and they're entering into the agreement, and the $600 will be available soon. So that'll be good news for a lot of people. The $600 is going to be only available until July 31st of this year. So it's not going to run until the end of the year like a lot of this other stuff. And it's going to start from the date that the state makes its agreement with the federal government. One of the conditions of the $600 is that the state can't decide it's just going to reduce its normal unemployment benefits. So it can't use the $600 to kind of lessen its load for unemployment. Employees can get the $600 if they have reduced hours, but they have to be receiving at least $1 in unemployment benefits in order to get the $600. Now, here in Kansas, and I think in other places, when somebody is working reduced hours, that doesn't necessarily mean that they're going to get money from unemployment, because they have to reduce their hours and then get less pay down to a certain level. All right. And so it is possible for somebody to have reduced hours, apply for unemployment, and get denied from the state because, you know, they're still making too much money. Okay. So that's something that employers need to keep in mind, because if they're counting on the $600 to be there for their employees, or they're hoping that it's going to be there for their employees, if the employees are working too much, making too much money, that may not be the case. This is where work share comes in. Now, work share is a program that a lot of states, including Kansas, offer, where the employer basically enters into some sort of an agreement with the state to reduce everybody's hours at the employer, or reduce a certain group's hours, and then in return there can be some part-time unemployment compensation paid. Now, this is important because if the employer goes through the work share program and qualifies, and that means that its employees who are now working reduced hours are going to be getting at least $1 in unemployment benefits, which in turn means that they're going to get the $600, which would be a nice thing. But if you're not doing work share and you're simply reducing hours, then the employees might not qualify for the $600, and they would be kind of disappointed in that, I would think. The third thing that the CARES Act did on unemployment is to provide something called the Pandemic Emergency Unemployment Insurance, which provides 13 additional weeks of benefits running, and the states have to enter into an agreement, and it's going to run from the date the state enters into an agreement through December 31st of 2020. This is intended to cover people who have exhausted all rights to regular unemployment, or who had no rights to regular unemployment, but they have to be able to work, available to work, and actively seeking work. Now, we're in the middle of a pandemic, so actively seeking work is a little problematic, and the Department of Labor recognizes that. So what they've told the states is that they have to offer flexibility due to COVID-19 as to what actively seeking work means, because, you know, if they're unable to, you know, if they're quarantined or subject to an isolation order or something like that, that's not supposed to disqualify them from the unemployment benefits. There's also a rule in this part of the CARES Act that says that the states can't play games and start reducing their normal unemployment. It's kind of an offset. And one thing to keep in mind, a couple of things to keep in mind is just because somebody applies for unemployment doesn't mean that they're going to get it. You know, if they got fired for embezzling from you, that rule's still in place that you're not going to get unemployment if you got fired for embezzling. Okay, so that, and then we call that the good cause requirement. So you know, if the employee terminated for a reason other than good cause, the employee is not going to be eligible for the unemployment benefits. But what if the employee can't work because of COVID-19? I mean, that's where it's a little tricky, because it's a little unclear as to how that's going to work with the good cause requirement. But it sure looks like what the federal government is saying is, look, states, you're going to have to modify your requirements and loosen up a little bit here, because we understand you've got these reasons that say, look, if you don't have good cause, you're not going to get unemployment, but we want you to be providing unemployment in these other additional situations, like for COVID-19. Another really important thing to keep in mind, I've had a number of clients ask me this, well, you know, what if the employee just doesn't want to come in and they just want to get unemployment benefits? Well, it is fraud if the employee quits just to get unemployment benefits, okay? And if the federal government finds that they did that, they're going to be all over them. So, and probably the state government also. So, you know, there's still rules about unemployment. It's not just a free-for-all. But I do think that states, including Kansas, are going to have, you know, a little difficult time in trying to figure out how to administer some of this. But hopefully the federal government will give us some good guidance here in the near future. Okay, here's another question. And this relates to the intermittent use of the paid leave. If an employee is experiencing symptoms and needs 2 hours for a doctor's appointment, does that 2 hours qualify for EPSL? I think that would be the paid sick leave, and the other 6 as regular pay if that person is working on-site or telecommuting. Yeah, so if the person needs to take 2 hours to go to the doctor's appointment to see, you know, to have a test run on COVID-19, that would be 2 hours of paid sick leave. And, you know, and if they then go home and can work from home for another 6 hours, then that would just be regular pay. So, you know, the employer is not relieved of its obligations to pay employees when they're working. You know, if they're working, whether at the office, on the job site, or at home, then you're still required to pay them just as you always have been. I mean, from that standpoint, it's no different than any other type of paid leave that you provide to people, or, you know, or your requirements to pay people when they work. Okay, I'm running out of questions. If you have some more questions, go ahead and shoot them over to me. For those of you who are already subject to regular FMLA leave, let's talk about how the expanded FMLA leave works with the regular FMLA leave, okay? So, you know, if you're subject to, if you're a covered employer and are already providing FMLA leave, you have a 12-month leave year. It might be the calendar year, it might be a 12-month look-back period, or it might be another 12-month period that you've picked. But you got 12, but the employees are eligible to take 12 weeks of FMLA leave during that 12-month FMLA period. Now, what if, like, you know, say you had an employee who was out on maternity leave already for 12 weeks during this current 12-month period, and now wants to take expanded FMLA leave. Well, they've already used up their 12 weeks. So that 12 weeks of expanded FMLA leave is not available to them. They of course still have the ability to use the 80 hours of paid sick leave, but they're not going to be able to use the 12 weeks of or any expanded FMLA leave until they roll over to a new 12-month FMLA year. So for instance, you know, if their 12-month FMLA period ends on June 30th of this year and they've already used up, let's say they took their 12 weeks because they had a baby back in January, they used up the 12 weeks during the current 12-month period. As soon as, June 30th was the end of the year, so as soon as July 1st hits, they're going to be able to take expanded FMLA leave, and 10 weeks of that will be paid. What if you got an employee who, say, used 3 weeks of FMLA leave already, and they want to take expanded FMLA leave? Well, during this 12-month period, they've got an additional 9 weeks of FMLA leave that they can use, and they can use 9 weeks of expanded FMLA leave. And then once you hit the new 12-month period, they're going to have an additional 3 weeks of expanded FMLA available. One thing that's to keep in mind is that the most that they can get of expanded FMLA leave is 12 weeks. So if they've got 9 weeks in this 12-month period and 3 weeks in the next 12-month period, that's all they can have, okay? So basically it's 12 weeks between April 1st and December 31st of this year.
Well, Jim, this is Scott
If you are
Schneider. Do we
self-employed,
have any more questions?
I'm sorry?
This is Scott. Do we have any more
Okay,
questions
Scott.
we'd like to finish up with?
I got one more question here that's on the Q&A. If you are self-employed and your customers won't allow you to work on their premises, would you qualify for unemployment as a self-employed individual? Yeah, I think that is going to be a situation where the 39 weeks of pandemic unemployment assistance comes into play. Assuming that the self-employed person doesn't have other work that they're able to do. So that's a very nice thing for people who are self-employed. Well, I hope that this has been helpful to you guys. If you need any help figuring out how to deal with the paid leave law, or have some additional questions about how the unemployment under the CARES Act might work and how that might influence your decisions on how to handle your employees, please feel free to contact me. I'd be glad to help you.
Jim, thank you for that presentation. Brad and Eric, thank you for spending the time to put this together. This material will be available on our website under the COVID-19 link. And if you need any additional information, feel free to reach out and let us know. This is the second day of our 2-day deal, so we're going to sign off and give everybody back their day. Thank you for participating.
Thank you, Scott.
Thanks, Scott.
Yes.